Meta collapsed after its earnings report. Should you panic and sell, or is this the buying opportunity we've been waiting for? In this video, I'm going to show you why Wall Street is completely misunderstanding Meta's strategy. I'll share my price target and explain why their massive spending is actually a brilliant long-term move. We'll also cover a key cybersecurity stock I'm buying and my surprising forecast for Bitcoin. Meta's revenue actually grew an incredible 26%, and their daily active users are at an all-time high. So what on earth caused the stock to plummet? The answer is one word that is changing everything: AI. Let's get straight to it. The market freaked out because Meta announced it's increasing its spending, its capital expenditures for the coming year. They're pouring billions into artificial intelligence. Wall Street hates this in the short term. They see increased expenses and lower immediate cash flow, and they hit the sell button. But this is where they get it wrong. Meta is playing the long game. They are sacrificing a little profit today for total dominance tomorrow. Think about it. Their core advertising business is a machine, thanks to AI improving ad targeting and content recommendations. This new investment will supercharge that machine. This spending will directly benefit companies like NVDA, AMD, and Arista Networks, who provide the essential hardware. My view is simple. This stock drop is a gift. The sell-off was a knee-jerk reaction to a one-time tax charge and a strategic investment plan. The company's core business is stronger than ever. My valuation models show a potential upside to $800, maybe even $1,000 in the next year if market conditions are right. If you're getting value from this direct analysis, take a second to subscribe to the channel. It's free, and it ensures you get the real story behind the headlines, not the panic. Now, Meta's move doesn't happen in a vacuum. The broader market is hitting all-time highs, with giants like Amazon and Apple being pushed up by this same AI optimism. But this creates a dangerous situation. The S&P 500 is extremely expensive, and it feels like the market is pricing in a perfect scenario, which rarely happens. And there's a key indicator many are ignoring: liquidity. Liquidity is just the amount of money flowing through the financial system. When it goes up, assets tend to rise. When it goes down, things get rocky. Right now, global liquidity is growing, but U.S. liquidity is starting to contract. This is a warning sign for stocks. This liquidity squeeze is one reason I'm also looking outside of stocks, specifically at Bitcoin. I'll tell you my Bitcoin price target in just a moment. But even with market warnings, earnings season always gives us specific opportunities. Let's talk about another company I'm looking at: Rubrik, ticker RBRK. Rubrik is a pick and shovel play in cybersecurity. That means instead of betting on the gold miner, you sell them the tools they need to dig. Rubrik provides data security and ransomware protection. As cyber attacks increase, their services become essential. It's a high-growth, high-risk stock, but I'm slowly building a position using dollar-cost averaging on any dips below 75. It's a long-term hold. Another interesting case is Chipotle. The stock got hammered because they signaled that their customers are struggling with affordability. This is a real headwind for the restaurant industry. However, the stock is now at a much more attractive price. Chipotle is a quality company, and these are the moments when you can start looking for an entry point. Now, back to the promise. Let's talk Bitcoin. With rising debt and central banks like the ECB failing to launch their own digital currencies, the case for a decentralized store of value gets stronger every day. The current fear you see in the crypto market is an opportunity. This is the time when strong hands accumulate from those who are panicking. The chart is telling a clear story to me. While stocks are at all-time highs, Bitcoin has been consolidating. I believe it's building energy for a significant move upwards. My analysis points to a potential target of $150,000 by early 2026. So, to recap, I believe Meta's drop is a clear buying opportunity based on a misunderstanding of their AI strategy. I am being cautious with the overall market due to high valuations and contracting U.S. liquidity, and I'm using this volatility to accumulate specific assets for the long term, like Rubrik and Bitcoin. Always do your own research and make your own decisions. These are my thoughts, not financial advice. Make sure you subscribe so you don't miss the next analysis. Now I want to hear from you. Are you buying the Meta dip, or do you think the high spending is too risky? Let me know in the comments below.